Alright, let's talk about the ETF. That's gonna be the first ETF reveal I did, and that's gonna be an iShares by the BlackRock. I ticker symbol IVV iShares Core S&P 500 ETF. Okay, this is the ETF, the index ETF, focus on the S&P 500. The 500 stand for the 500 largest company in the world, in the United States, Fortune 500 company. Okay, the portfolio allocation is based on the weight. So if the company has bigger, has assets, has bigger assets, then the focus, the investment focus will allocate more money on those companies with bigger assets and the larger assets, according to the weight allocating the assets. So weight-based allocation is indexing basically. And here's iShares 500 and seeking tracking the S&P index. So most ETF, equity ETF, if you want to look at the performance, you always use the ETF 500 index as a benchmark for the performance. If you want to take a look at the performance of the ETF, the benchmark usually, not all the time, is S&P 500 index. And the firm offer low-cost solution for the core building. Yeah, this is a core portfolio must-have. So a lot of retirement fund focus on retirement investment. They will buy iShares, the core ETF, S&P 500 as a quote. Most money will be put in there. Most retirement money will be put in there because it's diversified, it's broader market, and it's a U.S. Fortune 500 company in the United States. So let's take a look at the fact sheet. So we got a fund description here. The iShares ETF tracking the 500 index. Low cost solution for the quote building block within a portfolio. To notice they are only has exposure to a large cap US company. So they have largest 500 company in the United States. Here is a chart for the gross hypothetic $10,000, how much you can make. Look, you put $10,000 in 2000, year 2000. You hold it until the March 26, 2026. It's about $80,000. So it grew up like 8 times. So you put a $10,000 in, you get $80,000 as today. Not today, but March 26. So it sounds easy, right? But the road is not straight up, so it's very bumpy. So you go up and down. Take a look here. There's .com price right here. .com price right here. The internet bubble .com price right there around 2000. And the 2008 we have the financial crisis, the real estate financial crisis on the 2008. Then we have the 2020, we got a COVID. So there's a big dip right here. So a lot of investor will get a panic during those kind of financial crises. So if you buy individual stock, you just focus on a few company, it's going to be very difficult psychologically to hold the money for like 10 years because the volatility is too high. So you have to play the long-term game right here. Just buy into the index, just like most 401k retirement. The company you're working with, they put your money into an index fund, and just roll up. So that's the better way to invest. Just buy index fund. For most people. Here, take a look at the calendar year performance. Okay, there's the price, market price, there's a benchmark. So market price should be close associated with the benchmark, which means this index fund. So the number should be very close. As close as the better. And on the 2021, we got a 28% return. 2022 go down to 18% negative return. Again, 2023, 26% in a year. That's very impressive. 2024, 24%. 2 year put together is like more than 50%. That's really impressive. 2025, 17%. And here is annualized return. So average return. So if you put the money in, like into this index for 10 years, the average return is 14%. That's really high. And 5 years, you put only 5 years, that's like 12%. 3 years, 18%. So in the long run, the fund performs extremely well, like 14% on average for 10 years. So that's pretty impressive. Okay, let's take a look at the holding, which means the company they hold in those index. So there used to be a Microsoft Corp on the top, but only right now the Microsoft only has 4.91%, and Apple is 6.6%. And what we got here: Tesla, Meta, Alphabet Class A, Berkshire Hathaway, the Warren Buffett's company. Yes, this is top 10. This is a top 10 investment. Top 10 company. You allocate about like 36%, 36% of all your money into focus on those top 10 company. And many of the company is like the Meta, the Alphabet is a technology company, social media company. So Apple is a technology, Microsoft, Amazon, not really a technology company, but it's a very popular place people to buy stuff from. Got an Amazon delivery all the time. So, and on the top sector, as you can see, the 32% is on the technology sector, 12% is on the financial sector. Financial sector is like the bank, like the investment fund, bank, credit unions. That's a financial. Communication company, 10%, like T-Mobile, Verizon, this kind of communication company, the cell phone company. And consumer discretionary, 9%, healthcare, 9%, industry, 9%, and consumer staple, 5%, energy, 4%. So utilities, 2%. Other materials, others 2%. So pretty diverse. As you can see, they have 32%. 32% of the total holding is investing. Money is investing in technology company. So it's heavily focused on the technology company. Even it's a diversified broad core portfolio, but still focus a lot on the technologies. If the technology sector is not doing well, the S&P 500 will go down significantly. That's kind of risk you have to take. If you want to diversify, you always can add into like a satellite ETF or a sector ETF focus on whatever, like the oil, the energy. Although the energy is doing very well right now, energy ETF. Since we have some situation in the Middle East and the things with Iran, situation. But energy stock is very volatile. It's very sensitive to a geopolitical risk. Um, Asset class, key factor asset class. Let's take a look. Equity, basically means the stock benchmark S&P 500. Okay, the launch day. Okay, this ETF started from year 2000, so it's about 26 years. And distribution frequency, basically the dividend, how often they distribute the dividends quarterly. And share outstanding, there's enough share for you to buy. They list on New York Exchange, New York Stock Exchange. And here we take a look here. This is how much you pay for the management fee for invest in this S&P 500 ETF. Take a look at this, 0.03%. It's almost like free to invest. So there's very little. Like you invest $100, they take out 3 cents for the expense, the management expense, management fee. 3 cents out of $100. That's very little. 30 days yield 1.12%. Well, the yield is not exactly high, but if you want to focus on yield, you can buy ETF with high yield ETF. They are focused more on yield. This is just equity, just Fortune 500 company equity. That's all. Equity beta 1 and the PE ratio, PB ratio 4.72, PE ratio 25. That's pretty high. If you can get a PE ratio lower than 10 or a single digit, that's really considered as cheap, but it's all depending on the country you invested in, the equity you invested in. Like some stock usually have a high PE ratio, like a banking stock. Standard deviation basically shows the volatility of the equity you invested in. So volatility is like go up or down. So usually the high risk stock has high volatility, but does not guarantee the high return. Usually those like blue chip company, all the blue chip company like Apple, like Microsoft has relative lower volatility. Here's the number of the holding, 500, about 500 company. I don't know there's why it was 503, but usually around 500. All right, just a very simple overview of the iShares Core S&P 500 ETF, the ticker symbol IVV. You can buy this from the BlackRock and iShares. By the way, everything I said here does not constitute an investment advice. You have to make a decision on your own. Do your research. All right. Also, I'm not sponsored by the BlackRock, so I don't make money to making the video review of their ETF. So that's just something I have to let everybody know.